So let's look at creditors. Now, creditors within a three-way financial model is where we adjust for the differences between when expenses are incurred and when they are paid in cash. Now, when we first bring your historical creditors balances into your financial model via your accounting package, they're brought into the historical balance sheet within the creditors section within the current liabilities. In this example, we have one category of creditors, that being trade creditors, and we have their historical balances spanning across the right-hand side of the sheet here. And if I scroll across until the end of our historical period, which is June 22, you can see our closing balance of 94.7. When we're forecasting creditors, this analysis is located on the working capital sheet underneath our debtors analysis, and if we have inventory within our model, it's located underneath inventory analysis as well. So let's first look at the impacts of creditors within a three-way financial model before we dive into our example. Now, creditors is simply an adjustment to the balance sheet and the cash flow statement and does not affect the P&L of a business. Using $100 of operating expenditure as an example, if a business incurs $100 of expenses but only pays $40 in cash during a certain period, we would then need to adjust for the remaining $60 which is still owed by the business. This adjustment occurs within the creditors balance in the current liabilities of the balance sheet. This adjustment to creditors is also matched with an adjustment to the cash payments within the operating section of the cash flow statement. Looking at the cash flow statement, we have our $100 of expenses incurred, less the $60 of expenses that are not yet been paid in cash, leading to our net change in cash of $40 of expenses that have been paid. Now, jumping back into our example, when most people think of creditors, they think of creditor days as the calculation method. This is commonly used, however, in the context of a monthly model, if you have a highly cyclical cost base, or you pay your creditors off over a long duration of time, then this can lead to some strange adjustments in the cash month to month. This is why in a monthly model, we use a cash payment delay mechanic. A cash payment delay mechanic assumes that expenses are spread evenly across invoices received throughout an entire period. So that our creditors analysis is easier to understand, we're first going to wipe everything down to zero. Now that everything is wiped down to zero, we can see that all expenses are assumed to be paid in cash, and we have no expenses flowing through our creditors analysis. We have our opening balance of 94.7 being pulled through from our historical balance sheet, and this is not yet being received throughout the model. Our first assumption in column I is the period over which we assume we will pay off our opening balance of 94.7. If we assume that we're going to pay this off over one single day, then we can enter our forecast assumption of 1 day, hit enter, and you'll see that that entire balance is paid off within the month of July. Similarly, if we assume we're going to pay that off over a duration of 31 days, updating our forecast assumption, you can see here that the entire balance is still paid off within the month of July, as there is 31 days in that month. If we assume that we're going to pay off our opening balance over a period of 45 days, if we update our assumption to 45 days, you will see that the opening balance of 94.7 is then paid out across the months of July and August. The split between these months is assuming that the 94.7 is paid evenly in 45 separate installments, 31 of those installments occurring within the month of July, and the remaining 14 installments being paid off in the month of August, hence the lower repayment in August. Now let's look at how we adjust for forecast expenditure within the financial model. I'm going to allocate our television and media advertising expense line item into our trade creditors balance, so we have forecast expenditure to work with. As our current forecast cash payment delay assumption is still set to zero, you can see that our television and media advertising expense is still assumed to be paid as cash, and therefore our creditors balance does not move. Now let's look at October 22 as an example. The cash payment delay mechanic assumes that the 60.7 of television and media advertising expense for the month of October is received evenly across 30 invoices during the month. If we assume that each invoice is paid 45 days after its receipt, the first invoice received on October 1st will be paid 45 days later on November 15th. Following this forward, the 29 other invoices received during the month of October are then paid on November 16th moving forward. This is reflected in the cash payments spread across November and December 22 in this example, with 31.3 being paid in November and the remaining 29.4 being paid in December. If we apply this 45-day cash payment delay assumption to the entire duration of the model, you will then see our creditors balance come to life. Our creditors balance is then changing month to month. The change in creditors reflects two things: the payment of expenses incurred 45 days prior, and the adjustment for expenses incurred today, which will be paid 45 days in the future. If we assume we're going to pay our creditors over a longer period than 45, we can adjust our assumption to, say, 60 days. As we adjust this assumption, you can see that our creditors balance goes higher. As we increase our cash payment delay assumption, you can see that we have a higher creditors balance month to month. This is reflecting the assumption that at any point in time we have a greater amount of expenses owing to creditors, therefore we're maintaining higher cash at bank, and we need to adjust for this with a higher creditors balance on the balance sheet. Now, looking back at the financial statement impacts of creditors within a three-way financial model, it's important to stress that creditors is simply an adjustment to the balance sheet and cash flow of a business and does not affect the P&L or the profitability. Creditors is an adjustment to reflect the cash payment timing differences between when expenses are incurred and when they are paid. Within a complete three-way financial model, there are other areas to consider, such as whether you have GST. If you have GST within your model, then your creditors balance will increase as you also owe GST to your creditors on top of the expenses which have been incurred. Again, this GST will be handled within its own video. However, for the purposes of this video, creditors is simply an adjustment to the current liability section of the balance sheet and the cash payment section of the cash flow statement.